next session is what's behind the strong M&A market, and it's with Ted Rieple and John Wagner. And M&A is kind of a weird area, hard thing to understand. A lot of people for years when I would talk to M&A pros in this industry, and I'd want to understand how does this work, and then start talking about mezzanine financing and things that they go like this. So John Wagner was able to demystify, and that's what they do. They demystify the process. And John has a column in the magazine all about mergers and acquisitions, but it's beyond that. It's about helping to run your company more profitably. It goes pretty deep. But these guys are a big hit every year, so we have them back every year because they answer your questions. They answer them just clearly and honestly, and they do a great job. And they're really, really good at helping companies sell who are ready to sell. So with that.
Great, thanks Rick. And thanks for having us back. Hello everyone, I'm John Wagner. This is my business partner, Ted. We're here to talk about M&A, and it's just about the hottest thing in news because you pick up a LBM Journal daily newsletter, it seems there's an acquisition almost every day, if not 2 or 3 a week. Strategics are buying other companies, and the private equity groups are very, very active buying companies like yours that are family run. There's, with interest rates and volatility there's some talk that there's some headwinds. Believe me, in mergers and acquisitions, there's no headwinds right now. Ted and I have been partners for 10 years in the M&A business, and Ted's been in it a lot longer than I have, even though I'm a little older than he is. But we had this is our 3rd year of record years progressively, so it's a very, very active market. There's very, very active buyers out there. So we ask, really what headwinds. Acquisitions of LBM companies, there was a peak in terms of raw numbers of acquisitions in 2022, but in terms of values, it is actually stronger now than it's ever been. Companies are buying larger and larger companies, and Ted's going to go into those specifics here. Ted, take the next slide.
Yeah. Well, it's interesting. In the first half of 2024, there's been more LBM facilities or locations acquired than the full year since 2016. And if you look at the numbers, SRS and the Home Depot acquisition of SRS contributed 770 of those locations, but there was also 196. So we're talking about over 995 locations or facilities was acquired in the first half, and that's been unmatched since 2016. So it's a big deal, and I think what's happening right now, it's a mega deal for sure, but it's really made a big difference in terms of where the market stands right now. So we really believe that it's one of these things where there's going to be other mega deals go down in the future, but there's an opportunity right now in terms of M&A that we see this as it's going to be continuing to 2025 and beyond. We see a lot of activity. The market, some of the things you've heard in the conference, the market may be flat or whatever. It's not true of M&A. And I think the big thing here is that the big guys are out there now looking for stuff. So there's an opportunity for, if you're ever in the interest of selling your business, there's some real opportunities going on right now.
So we just showed the pictures of the most active buyers out there. We've done deals with all of these companies along the way at one time or another. And here's a list of some of the strategics that are doing acquisitions. TAL is here, 84 Lumber, Mead, ABC. There's no lack of money fueling the acquisitions. In fact, the kinds of deals that we do, that we call them cash forward deals, a couple years ago, because the lumber price spike, people were doing some seller notes and they were doing some earnouts to protect, the lumber was so volatile back then. Now the offers that we're getting and managing, and we're in a number of deals right now, are really cash deals plus an escrow. Every deal has an escrow, but it's cash forward.
Yeah, and getting back to that other slide, John, in terms of the most active private equity basket of acquirers, if you take a look at it like SRS was actually owned by 3 they went through 3 various private equity groups. And they were founded in 2008, SRS. And from their founding in 2008, they have grown their business to $10 billion in sales. and approximately $1 billion of EBITDA. So they've had a great run. But a lot of it has been based on the fact they were bought by private equity. And, you know, with private equity, they've got the money. They can help grow your business. So if you look at the numbers, you're looking at SRS that was bought by Home Depot, and they're growing like crazy. You look at Kodiak. Kodiak is private equity. They're owned by Court Square, USLBM. That's Bain Capital, but Bain Capital then sold 50% of their business about a year ago, I think, John, right? And to, Platinum Equity. So the private equity is playing a major, major role in terms of how this, of all the acquisitions that are going on right now.
So we'll talk now in the next couple of slides about why are they still acquiring and the multiples that they're buying at, and Ted will go into this more deeply, that there's an arbitrage of the multiples, that they're buying at 5 and 6x and then selling at substantially more than that when those companies in aggregate represent a much bigger operation.
Right. And I think at the end of the day, what we're really looking at is I think you've got to take a look at in terms of why they're acquiring. Part of it is that it's a great opportunity for them. It's a business decision. They've got other sectors they could go to. They look at a lot of different things. They're agnostic in a lot of ways, but they've seen this building material as a real opportunity for them. So part of it is that they see this as an opportunity market, if you will. The other side, it fits their business model. From private equity standpoint, they've got a playbook, and that playbook is consistent with almost all the industries they work in, including this one. But it starts out with the fact that they've got the capital. You have to have the capital, and they've got the capital on hand. They do it through different funds. They got Fund 1, Fund 2, and Fund 3, but they've got the money to make the whole thing happen. The other side of it is what they do is they go out and look for really some of the top management to start these roll-ups, if you will. And you look at who runs USLBM, who runs Builders FirstSource, who runs Kodiak. These CEOs are very experienced guys that really know what they're doing, and they've demonstrated that. The other is the scale of the business. And the scale of the business goes through a lot of different things, but that you can really make additional money. If you start looking at it, when you get a $3 billion company, as an example, Builders FirstSource right now, I think they're public, but Builders FirstSource is, I think, operating at about a 13.5% EBITDA margin on a business that's, $18 billion in sales. So they bring efficiency to the whole thing too. We're not here to sell private equity, but we just want to give you at least a background how it all works. The other part of that is that they use other people's money. That's a big deal. So when you look at these acquisitions, that when they go out and buy a company, they're basically paying about 50% in equity, and they're getting the other 50% either through senior debt or mezzanine debt. So they're using the banks to help fund these deals too, and that's how they get the leverage.
So when you get an offer for your company in the form of an LOI, most of the LOIs we receive are not financing contingent. They're basically offering all cash, but then they'll gang up a bunch of companies together and then go to the debt markets to wrap up the debt that finances, again, around half the deal values. But you don't take that risk when you're acquired because, as I say, these are more cash forward deals.
Exactly, but at the same point though, John, too, is that when you look at in terms of what the private equity guys do, the last point on that whole equation is it's called multiple arbitrage. And the multiple arbitrage, it gets back to this in terms of what they're buying they go out and they buy a lumber yard and they pay a 5 or 6x on that lumber yard. They turn around when they get to a certain scale. In the case of, let's say, USLBM, when you're $18 billion, all of a sudden if they get sold, they're going to probably sell for anywhere from 10 to 12x. So they're doubling their money. So it's called that multiple arbitrage. But to get that multiple arbitrage, it's scalability. You've got to be big. The bigger you get, the more money, the more the multiple goes up, just like that.
So Ted and I were going through these slides earlier today, and people out there, I'm sure you're saying, well, why am I selling my company at 6 times adjusted EBITDA? And then 2 years later, I see that the company in aggregate is selling at 10 or 12 times EBITDA, and that's a future slide. And we say, well, if you want to go out and raise $3 or $4 billion, go ahead and you can do it yourself and roll up all those companies. But you can, as we'll point out, you can roll shares, and we're in a roll-up process now, and a lot of the acquirers that acquire our clients ask for share rolls or let people roll shares in the company in aggregate that they're acquiring. So look for that opportunity in your deal structures. We still have a fairly fragmented market out there. I like to use the analogy that, 15 or 20 years ago, there were over 20,000 independent pharmacies in the country. And now how many family-owned pharmacies do you have in your town? You have instead CVS, Walmart, Walgreens. The same thing is happening really in the lumber and building industry. And the roll-up will continue, but we think it's going to be measured in years and not decades, because the market is increasingly less fragmented, and we'll show you that the companies are buying in geographic concentrated areas. If you have a business that supplies lumber, building materials of any kind along that Route 35 corridor between Laredo and Temple, Texas, you're in a really golden thing. And that's when you start to map those acquisitions, and we've got a map we'll put up here. A lot of the acquirers are buying clusters and then taking advantage, as Ted said, of those synergies as larger companies. The multiple of EBITDA that Builders FirstSource is operating at, the EBITDA margin that Builders FirstSource is operating at probably exceeds what you guys are doing. Most of the companies we see are in that 7 to 11% EBITDA margin, and they're actually increasing that efficiency even though it's a much, much larger company.
Right.
Here's a map, and you can see the lumberyard acquisitions, component manufacturers. If you run a component manufacturing place, please call us. Those are highly liquid companies, and people are really looking to put them up, especially with interest rates, going down a little bit. Those are the companies that really, really are highly valuable today. They operate at higher margins, those of you who run them, than a pure lumberyard.
Yeah, I think when you look at the distribution, these are 2023 numbers right here, but there's so many opportunities out there, and you've got them looking at it. The buyers are looking at different things because, and by the way, just because US LBM or somebody's looking at a particular industry, they may have saturation in a particular market. They may have saturation in DFW, as an example. They're not going to be looking for other deals in DFW. So every deal we do, we take it out to the various buyers, and they change based on where they're at in terms of what they bought and what their priorities are. So it's a fascinating business, but it's kind of like it's moving all the time in different directions.
So the multiples today, and this is the key number that determines the value of your business in a sale. And again, usually it's cash at close minus a 5% escrow, which is usually held for about 12 to 15 months. It's 5 to 6x. Now, we've sold companies for higher multiples than 6, and we sold them for less than 5. It's highly sensitive to the KPIs that I'm sure you all watch. OpEx as a percent of sale, EBITDA margin, EBITDA in terms of raw dollars. If you have a $10 million EBITDA company, you're going to get a higher multiple than a $2 or $3 million EBITDA company. The threshold for interest from a private equity-backed acquirer is really $2 million of EBITDA. We get contacts from a lot of companies, and people say, I'm kind of out of gas, I'm in my mid-70s, I want to sell the company. And we have to be honest with them, and we wouldn't take on a client that we didn't think we could sell. But sub $2 million EBITDA is a hard company to sell today. 2 or 3 years ago, if you were in $1 million EBITDA, you could sell the company for $5 or $6 million and walk away with a nice chunk of change. That's a little different now. It costs a lot of money in due diligence and legal fees, both on the buy side and the sell side, to sell your company. And so $2 million is really where that interest starts.
Yeah, and I'd add to that too is the sustainability of your EBITDA. It's critical. Because we have situations where all of a sudden somebody's EBITDA is up to $5 million from $4 million or $3 million. What the buyers are really looking for is it sustainable, and that's a big deal, especially when we went through the price effect. When lumber prices went up to $14.40, $100 for 1,000 board feet, all of a sudden we were trying to figure out what is a sustainable EBITDA. Now it's settled down, but they still are looking for that sustainability. So and when I say sustainability, the history of your EBITDA over a period of time, at least a 2 or 3 year period. So if it's consistently going up like that, that's exactly what they want to see.
So a deal will typically be priced at a multiple of trailing 12-month EBITDA, or your last fiscal year or last calendar year of EBITDA. But if you went at $1 million 1.5 million, 1.3 million EBITDA over 3 years, and all of a sudden you're up to 4. This is Ted's point, is that people question how sustainable that is. So there's a quality of earnings review, and believe me, there's some very smart people on the buy side. Those private equity groups employ all the guys that did a lot better on the SATs than I did, and they have MBAs and they're super sharp, and they go in there and crawl through your books during the due diligence process, which is usually about 90 to 100 days, and they're looking for sustainability of earnings. Big key point.
And John brought it up earlier too. I mean, if you look at it, keep it simple. I mean, they're looking at really 3 or 4 different things that really are critical for them. And in terms of improvement over the prior year, sales is one of them, obviously. Are your sales going up at 3, 4, 5% a year, or what are they going up? The other one is gross profit margins. That's probably one of the key ones. And they're looking at, if you're at 27% gross profit margin, then all of you are at 28. They love that. I mean, that's one of the things that they're really looking at. And then the other thing is then OpEx as a percentage of sales. That's the other target in terms of KPI. They really want to see, as your sales go up, technically what should happen is your OpEx as a percentage should go down. And that's what they're looking for. So they're looking for everything going up like this. But when it comes to OpEx as a percentage of sales, what they're looking for is it going down as your sales and your gross profit dollars go up. And then the last, and obviously the most important, what's your EBITDA margin? Again, what's the progression of that EBITDA margin? If you're currently operating, let's say on, we call it the 10 plus 10 rule. They see a 10 plus 10 rule as a premium company. If you're operating with a 10% growth in top line sales, and if you're operating at 10% or above on EBITDA margins, they see that as a very prime, and that's what they're looking for if you can get there. Not all companies can do that. Not all yards can do that. But those are the key metrics they're looking for.
So for example, we sold a company in the past that was doing about 40 million in sales, but their EBITDA margin was sub 5%. So they did not achieve a premium multiple on that because they were really churning dollars to not make a lot. So if you have to have a good product mix out there, I'm sure you got to sell commodity lumber. It's not necessarily high margin, but you're blending in your millwork, your door shop, your windows, your roofing, your insulation, all those value adds, those higher margins. That looks really attractive in a kind of margin profile of your company.
Exactly.
We only have a half an hour today. I know we're moving quickly through this, but then we're doing a 90-minute roundtable if you want to join us for that, and we'll probably take questions at that time, but we're about halfway through the presentation now. So we're in the middle of a roll-up right now, and Ted's going to tell you about his experience in leading 2 of these in a slightly different industry. But where are we in the roll-up? That's a big question, and you look at your age, your retirement age, and what you want to take off the business. We've actually found that a lot of the people who call us right now are in their 70s, and they're kind of out of gas. Maybe their parents were the greatest generation. They started a lumber yard. They had some downtown real estate, and they're World War II era veterans. Those are the parents of the owners today. And they call us, and they're 70, 71, 72 years old. And they, you know what, my kids don't want it. They want to work for Facebook and Google. They don't want to load trucks at 5 a.m. And so we got to sell the business, right? So that roll-up, this urge to sell, of this kind of aging out of the owners, and I'm not saying you're all in that position, this roll-up started, look at Kodiak, it started in 2017, SRS 2008, and where are we in the roll-up? As I said earlier, it's going to last years but not decades. A lot of the elephant hunting, we call it elephants, a lot of the elephants are in the zoo, the highly desirable large companies that want to sell, the Zarskis and people like that, they have been acquired. Now make no mistake that it's a very acquisitive market. There's a lot of buyers out there, but a lot of the desirable companies have sold or are talking with companies like ours. And you'll see, if you start to look at the categories of what's being acquired now, it's a verticalizing of their portfolio. They're buying the millwork shops, they're buying the window shops, they're buying the slightly higher margin items and capturing that margin that they were losing to companies that they didn't yet own.
Good. Yeah, the other thing here is on the roll-ups. I know, like John had mentioned, I'd been involved in a couple other roll-ups. Prior to starting First West M&A, like 15 years ago, I ran a specialty chemical business. In today's dollars, it was about a $500 million business, and I acquired about 14 deals in that roll-up. The other one was I started a distribution company with a private equity group, and we grew that up to about 150 million, and we took it on NASDAQ. But there we acquired about 14. companies, but we were part of the roll-ups both in specialty chemicals and industrial distribution. So I've got I'm an ops guy, kind of that become an investment banker. But the bottom line is that there's some real opportunities, and I think the important thing here is that if you take these 50 LBM dealers at $5 million of EBITDA, you've just created a business now that's a $250 million business from an EBITDA standpoint. And do you think the acquisition multiple is 5 or 6x on a $250 million when they sell? No, it's anywhere from 10 to 12x. So once you get that scale, it's amazing. And but even an example here, this is really kind of amazing when you think about it. Everybody knows about the SRS and that Home Depot acquired them. We're talking about 10 or 12x doubling. The reality is when Home Depot bought SRS, they paid a multiple of 16.6x for that business. And what's really interesting, Home Depot is trading right now currently at about a 17x. So Home Depot did not get any real great accretive value, if you will, because they're both trading at about the same. And that's another word, by the way, that you all should think about too, because when you're selling your company, if you're accretive, in other words, if you're higher than their EBITDA margins or your gross profit margins are higher than their gross profit margins, they really look favorably on that, because the minute they buy you, they've just improved their EBITDA margins. So the word accretive plays, but anyway, that's a story about SRS in terms of they got a really good deal, and they paid $18 billion for that too.
So you can see why private equity groups can find investors to put money in, because over time with patience, they will double their money and do a lot better than a Vanguard index fund. I mean, these people are out there to really double their money in a 3 to 5 year window, and that's what's happening. That's what you've seen. Kodiak is actually in its 7th year. Court Square has owned Kodiak for 7 years. Usually the holds are a little bit shorter than that, 3 to 5. But the limited partners who put in the money, they put it at risk. It's used to do this, but they expect that you're buying at 5 to 6 and then selling at 10 to 12, and that's pretty common if the deals are done right.
Well, I think where should you be in a roll-up timeline? And if you go to the next year, John, I mean, it starts here in terms of the beginning of it, right? And that's really where you want to be. The sooner you get into the fund when they're starting the roll up, because what's happening is you're as it goes up, you're getting value on that as it goes up, especially if you've rolled shares in the business. On a typical deal with private equity, they typically would like the owners to put anywhere from 10 to 20% of the deal back into the fund. And there's a lot of guys, or a lot of companies that are making a lot of money right now that have 20%. If you're a Kodiak deal, or if you're a US LBMer, I mean, eventually you're going to make a lot of money. You're going to take advantage of this whole arbitrage, especially. So you sold your business, you took the chips off the table, and on top of that, assuming that they're right and they're going to do what they're supposed to be doing, you're going to take advantage of the arbitrage. So all of a sudden, that 5x that you sold it for now becomes a 10x when you get your money out of it.
So if you roll 20% shares, 20% of your deal value in shares, that's a dollar for dollar reduction of the purchase price at close. But then you're going to probably get dividends if the company you join is properly run. You will get dividends on those 20% share rolls, and then if they have what's called a liquidity event, then you'll get. You'll probably actually get another chance to roll further into yet another entity, but you can also take your chips off the table there with your 20%.
Well, I'll guarantee, like on these deals, you'll typically see them sell to one private equity group, and that equity group sells to another private equity group, and it goes to another private equity group as it goes up. And a lot of times you can exit at any one of those times, but a lot of times what you'll do is you just continue to roll yours in to the next deal, and then it just keeps building in value.
So, as I mentioned earlier, a lot of the highly desirable companies that want to sell have been targeted by the private equity groups and approached, or they've approached companies like ours to sell them. There's lots of independent companies out there. TAL's got 32 locations. Mead Lumber is a very strong Span and Rose. There's a lot of independent and family-owned businesses, and I know that a number of you are here with very, very successful businesses, and you don't want to talk about acquiring because you want to build the value further. But again, there will at one point be a kind of satisfaction among private equity groups, and it won't be quite as attractive for the LPs, the limited partners, to put money in to buy more companies because a consolidation, which is occurring now, will have occurred and reached kind of a steady state.
Right.
The buyers, as I said, are starting to concentrate along geographic areas. In other words, as Ted said, they don't buy overlapping companies that would otherwise compete with one another. And then the other point here is they're verticalizing. Why give away margins and let another company sell windows to the guys you're selling framing kits to? Well, we'll buy the window company. And that kind of liquidity is out there. That kind of money is out there to do those kinds of acquisitions. Again, you start to see those press releases and you study the kinds of companies that are being acquired. There's still large retailers for sale, and we're selling them. We're involved in deals right now that are in due diligence of very large retailers that have held out, and now they decided it's time to sell. But we're also talking to other companies, millwork, window companies like that, and they recognize as well what's happening with that kind of capture of margin outside the core retailer vertical. Moving from, as I just said, millwork, windows, siding, appliances, drywall. Go look at the Kodiak portfolio. They own rebar companies, they own an appliance company, and you start to see this thing, well, why are we giving this business to somebody else? If we're bidding insulation, we're bidding roofing, why don't we bid your windows too? So the most attractive targets, Ted.
Yeah, I mean, it's LBMers are complementary locations of existing holdings is one of them for sure. Value-added high-margin distribution manufacturing. And then EBITDA greater than 2 million in strong GPMs percentages, but I'd add to that EBITDA margins too. That's important. That's like we talked about.
5 minutes to go. Rick gave me the signal here. So will the roll-up continue? Yes, it will, but not forever. Buyers are more selective now. Watch for regional saturation. Multiples will hold at 5 to 6. Again, we've gone over 6, we've gone below 5. It's sensitive to those KPIs that we talked about. And as I say here, sensitive to your margins.
That's it.
That's it.
That's just about made it.
All right.